Welcome to Straight Talk on Retirement, your no-hype source for financial advice and making informed choices about your retirement planning. Get on the phone to talk today at 969-KTRS.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Aaron Lapidus.
Well, hello, St. Louis, and welcome to Straight Talk on Retirement. You're live and local, St. Louis's favorite financial call-in show. I'm Jeff Lapidus, president of JBL Financial Services. Our offices are located in beautiful, slightly overcast, downtown Olivet, Missouri. I'm a 40-plus year veteran of the financial services area, a fee-based financial planner and wealth manager. And I'm joined this week and every single week by my very favorite, oldest, prodigal daughter, Aaron Lapidus, who also is a fee-based financial planner and wealth manager.
And we help our clients make smart choices about their money. The way we do that is by designing a game plan, a written step-by-step strategy, a real game plan that has several goals in mind.
First is to preserve, protect, and prudently grow the assets our clients have taken their entire lifetimes to accumulate. Second is to deliver a reliable stream of income, one that they can count on so they can do all the things they'd like to do during retirement.
And third is cost-effectively addressing their health care needs, like helping individuals enroll in Medicare and choosing the right plan to supplement their medical coverage.
And then when they're done enjoying their assets during their lifetime, we show them how to pass them on to the people they love, whether it's their spouses or children, grandchildren, churches, or charities, whoever it might be, with Uncle Sam or the tax courts taking a big bite out of their money. And as their wealth managers, Aaron and I watch their money every single day to make sure they're staying on track. And that's why they call us the retirement coaches. Good morning, babe.
Good morn.
It's a fun morning this morning.
It's the best morning in 15 years.
That's right. This is our 15th anniversary on the air. Kind of fun.
Well, I mean, it's not really 15 since I only joined you 8 years ago now.
Yeah.
I mean, that's when time really began.
As time goes by.
Exactly.
In your reality, that's when time began. But for everybody else, we've been here for 15 years. And it really has been a fun run. And so I do want to take the opportunity to thank the station for permitting us to bring our show on the road here.
That's right.
Obviously,
and to all of our listeners for listening every
For listening,
day,
and many
month.
of the folks over the years who have become clients. And as you know, all of our clients are our listeners.
People just like you.
They're 55 and older. They would like to retire, or they're already retired. And we create a game plan for them that has the goals of creating a fun and hopefully financially secure retirement.
That's right.
And that's there's not much more fun than doing that. So again, we do want to thank everybody this morning. We do have a lot of things on our mind. What's more important is what's on yours. Our phone lines are always open, 931-5877, star 5877 from your cell phones, or 84126 from the increasingly popular text line.
You know, you get lots of texts.
We do.
Good stuff.
Which is wonderful. And we do want to remind everybody that there are ways for you to keep in touch with Aaron and I during the week.
That's right. You can log on to our website, jblfinancial.com. In the lower left-hand side of the screen, there's a pop-up box that appears. It says sign up for our monthly newsletter. We call it the Coach's Corner. You just provide your name and email address, and we'll send that out to you every single month. Also, if you click in the upper right-hand box, it says contact us. You can send us a question, request a coaching session, whatever you like.
Exactly. Aaron and her staff do keep the last 6 to 8 months of those archived for your viewing, printing, or downloading convenience.
And because it is May 8th, 9th?
Yeah.
It's May 8th, the 8th of May. We have a brand new newsletter.
Fabo.
And I have it here.
Wonderful.
The first article is IRAs are top tool for retirement savings.
Yes, they are.
Individual retirement accounts are the largest pool of U.S. retirement assets, which totaled $33 trillion at the end of the third quarter in 2020.
That's great.
Well, I think this is a little misleading because the other categories are defined contribution plans, which would be 401ks, 403bs, private sector pensions, government pensions, and annuities. Well, as more and more people are retiring with larger and larger amounts of money, they're moving from 401k to IRA.
Well, that's why they say this is the baby boomer generation is the greatest transfer of wealth.
That's right.
Going
And I
on.
mean, only over the course of the last 5 years, it looks like already $4 trillion moved from 401ks into IRAs.
We helped out on that a little bit.
A little drop of that bucket.
Yes, we
We
did.
assisted in people
Yeah, and
moving there.
and it's fun, and that's why we do offer everybody a free coaching session at our offices. It's fun, it's free. We have the best coffee in town, and we also have the biggest parking space in town.
at least in Olivet.
Exactly.
And that leads us to the second topic, which is how well do you understand retirement plan rules? And this is a fun-filled quiz. I think we should do one of the questions
Sounds great.
live. This is one of your favorites. If you roll money from a Roth 401k to a Roth IRA, you can take a tax-free distribution from the Roth IRA immediately as long as you have reached 59 and a half.
Kind of true.
I didn't even give you the options, and that is correct.
Well, honey, this is my work. So
Well,
it is kind of correct. I mean, the
So,
fact is that you
it
need
says
to be...
it depends.
Right, it depends. You need to be 59 and a half. That's the threshold.
Mm-hmm.
But the second threshold is that Roth IRA had to have been in existence for at least 5 years, or
Right.
the distribution would not be considered tax-free.
That is spot on. Beware of the 5-year rule as it applies to Roth IRAs. If you establish your first Roth IRA with your Roth 401k rollover dollars, you will have to wait 5 years to make a qualified withdrawal from your Roth IRA. However, we know, because we were just mentioning, helping many individuals with their rollovers, not only from traditional 401k plans, but from Roth 401k plans, which are
403Bs.
newer.
Mhm.
If you need some tax-free dollars at retirement, or you'd like some tax-free dollars, if instead of rolling over your Roth 401k directly into a Roth IRA, if you take a direct distribution from your Roth 401k
Right.
before the rollover, then it is tax-free.
That's correct. Very good.
So there are ways to not get around the rules, but use the rules to your advantage. The next article is Growing Interest in Socially Responsible Investing.
Hold on. Before we start,
I'm sorry.
where's my star?
What star? I thought
I
I
got
gave
the
you some
question
pretty I thought I gave you some pretty serious accolades there. I mean, how much more are you looking for? You did say
Okay.
it is your work.
Okay, you're walking
Be good
home.
that
That's
you
it.
know things
walking
about
home.
it.
Uber.
Like on your dime,
Aaron and I do ride together every time.
by choice even, if
on
you
the
could
way
imagine
up,
that.
on the way back is always a question.
That's cute. Growing interest in socially responsible investing. There's growing interest.
Sure. I'm interested.
So this includes environmental, social, and governance. But I would say that you would want to be aware of what you're investing in. For example, we have quite a few clients, and we know quite a few people that are very interested in renewable energy. And
Yes.
it's important to make sure you see all of the companies that are being invested in if you're specifically interested in renewable energy, or if you are more interested in social responsibility. Those two things don't necessarily align, because as we know, many of the large oil producers are also heavily involved in the production of green energy, of renewable energy, whether that's carbon capture or even some of the development of solar panels, wind turbines, things like that. Because just like in the tobacco market, when vaping became popular, these companies don't want to lose market share, so they adapt and move into new markets that are, relatively similar to what they were doing in order to maintain customers.
I like that. Article 3, please.
The final article, Your Business, Minimum Wage Laws in the Spotlight.
Okay.
So if you
This is
happen
good for
to
our
be
business owner clients.
Exactly. It's nice. We have a nice diversity of topics in our newsletter every month, I think. Usually spans more than one generation
Yes.
and also more than one type of investor.
We call it the Coach's Corner, easy to access. Just go to our website, jblfinancial.com. Click on that floating icon or go to the bottom left-hand corner. Sign up. We love to send it to you every single month by email.
That's right. And it's great because when you receive the email that the newsletter is available, we've enhanced the experience a little bit in that sometimes we're including audio clips from the show that might relate to some of the topics in the newsletter, but also you can click on each individual article if you're specifically interested in that moment, something caught your eye and you'd like to take a look. So
awesome.
Very cool.
Very nice. And again, if for some reason your computer's on the fritz or you can't wait.
Cannot wait.
You got to say, you know what, we got to call for a coaching session. That wouldn't be unusual.
Right.
314-863-0008. Again, 314-863-0008. Or again, hit the contact us section. We would love to see you. And a lot of folks do that, honey.
Yes.
Whether it's for specifically coaching sessions because they want to talk about retirement, but also there are some folks that they want to engage in Medicare.
They do. And that is a perfect way to get a hold of us.
Exactly.
We're also going to add some enhancements to our website so you can fill out our ever-popular questionnaire online.
We're going to talk about that in a few minutes
Yes,
as well, because
we
that's
are.
really kind of the core of the process that happens. But
Right.
I do want to mention that, again, our phone lines are open. We'd love to hear from you, 931-5877, star 5877 from your cell phones, or 84126 from the text line.
That's right.
We've got approximately 7 days left until this year's on-time tax filing. Everybody got an extension, but I do want to remind folks that there are a couple of overlooked tax breaks that you may be not thinking about, but you certainly, if you're eligible for them, you don't want to miss, right?
First and most importantly, I would say, traditional IRA contributions.
Right. If you're under 50, you can contribute up to $6,000 per year, as long as you're under the age of 50 again. And if you're over 50, you can contribute $7,000 per year.
But you also have to make sure that if you were contributing to a 401k plan, if you'd also like to contribute to an IRA, you have to meet certain qualifications. You can't do 100% to both.
And these are really income limits. So as an example, if you're single,
Mm-hmm.
and if you're earning less than $65,000, guess what? You can make a full deduction up to the $6,000 or $7,000 limit. If unfortunately you're single and earning $75,000 or more, guess what?
Only a partial deduction.
Well, over 75, you get Zippo.
That's right. So there wouldn't be a reason. So you wouldn't want to make the contribution to a traditional IRA if you do not get the deduction, because then what you've done is double tax yourself. Essentially, you paid taxes on the money now because you're not going to be getting the deduction when you file, and then eventually, when you'd like to pull money from that IRA, you're going to be paying ordinary income tax. So
Right.
you only want to put money into traditional IRAs that you are receiving your full deduction for.
Yes, and you have to be careful, Nicole. So this really does apply for Roth as well. So
Right.
if you're a married person filing jointly and you're earning less than $104,000 as a family, you get a full deduction. If you're over $124,000, you get no deduction. If you're in the middle, you get a partial deduction. Right?
Well, as opposed to deduction for the Roth, that just means that you're able to make the contribution. Yes. So if you're earning more than $104,000 as an individual, then unfortunately you've been locked out of a Roth contribution unless it's a Roth 401k.
So if you're working with a financial advisor or you're working directly through a financial institution, you got to get moving, because that contribution has to be made before you file your tax return.
It has to be dated, so even if you drop it in the mail, that's okay, but it needs to be dated before you file your taxes.
And most custodians really want this money before the filing date.
Yes, they do.
They're pretty firm about that, and I would tell you that for all of our clients, our custodian is just like that. So if you haven't done it, you want to do it, and you feel like doing it, you're certainly most likely going to talk to us about it first, and then
we're going to make it happen.
Right, we'll make it happen, and most likely it'll be happen by transfer as compared to by check.
Right.
Okay.
The second thing that many people miss out on, and we talk about this very frequently, is health savings accounts.
Right, and you have to be eligible. First of all, you have to have a plan.
Right, you have to have an HSA eligible health insurance plan.
But if you do that, you can put away up to $3,550 for yourself or $7,100 for a family. And what's cool is that comes right off the top.
Also, there is a catch-up provision with HSA accounts as well. So if you're over the age of 55, you can put in another $1,000.
You know, the big deal here, obviously, is number one, having a plan that is eligible, a health plan that is eligible for HSA contributions. But the second thing is, and I know we talk about this a lot on the show, is Medicare.
Right.
But Part A.
If you are enrolled in Part A, you've locked yourself out of HSA. Oh, that rhymed.
That's right.
It's true, too.
And we do see that occasionally.
Unfortunately.
Where one spouse may go and enroll in Medicare, Part A and B. Guess what? They're no longer eligible, but their other spouse may be.
Right. So in that particular situation, if one spouse is eligible for Medicare and has enrolled in Medicare Part A, or you've made the determination that you need to take your Social Security benefits, which will automatically enroll you in Part A, and your spouse is still enrolled in a qualified health plan that meets the HSA guidelines, then you can drop down to an individual contribution as opposed to the family contribution. However, the cool thing is, as long as you are filing together, that your spouse that now has Medicare can use those dollars. So they don't get locked out of the use of the dollars. You just are not able to contribute on their behalf any longer.
Yeah, and the beauty of these HSAs, honey, as you said, is that they're triple tax preferred, right? The money goes in. You write it off. It grows income tax free. And then when you pull it out, assuming you're using it for health care needs, guess what?
What's that?
Tax free. Nothing's better in the Internal Revenue Code than HSA.
Right.
Period.
Triple tax advantage.
Triple tax. Thank you.
Would you like to interrupt this topic for a text question?
Naturally.
All right. Hello, and congratulations on 15 years.
Woohoo.
Thank you.
Thank you.
Now for the question. How much of your client's portfolio do you like to see in dividend income, or is it catered to each client?
It's good. No, that's a good one.
It is a good question. You just stared at me for a moment.
Because I was thinking that you were going to jump on the answer, but then you stared at me, which meant I was supposed to take it.
I thought you would love to answer this question.
Okay.
Wouldn't want to deny you.
So I would say this. I would say the best way that I could answer this particular texter is that Aaron and I don't currently use dividend income as a portfolio objective.
That is
in creating somebody's income.
However, if somebody comes to us with an account that is taxable, meaning when we make trades that they're going to get capital gains or something along those lines, then we might work it in if they happen to be holding dividend-producing equities in that portion of their portfolio.
You know, we tend to be more growth-oriented. Mm-hmm. So in most cases, every 6 months we're doing portfolio rebalancing, mm-hmm. and that's when we're skimming gains and funding clients' cash needs. So we're really not looking to depend upon dividends or, truthfully, interest income as a way to create the income stream for our clients.
And I would say that that's been our philosophy for quite some time. However, it really seems to be holding water at this moment because we've noticed that, over the last year, a lot of companies had to cut or suspend dividends. So a lot of people may have seen some hits to their dividend-producing portfolio.
Yeah, I think, again, it's a question of how are you measuring risk.
Right.
We know that there is risk that companies will not necessarily be able to maintain their dividends.
Right.
At the same time, there is a risk on the other side for growth. Will the growth actually occur? Mm-hmm. We know that in our studies of the markets, mm-hmm. The growth side of the portfolio has been whooping, whatever you want to call it.
Has been outpacing the value side, which is typically the dividend-producing side.
Thank you for that, babe.
Compliance appreciates, I'm sure.
Over the last 5 to 8 years. So being growth-oriented in your portfolio made more sense than being dividend-oriented.
Right.
This is something that we are carefully watching mm-hmm. all the time, and we're making decisions about this in terms of our portfolio construction for clients during our 6-month annual rebalancing.
Absolutely. And sometimes we have individuals that come to us that most people already have financial instruments when they come to see us, either 401ks or they've created some savings for themselves or investment accounts for themselves outside of their employer. And Dad, as you always like to say, let's not pay taxes on money we're not using. So if we find that they have been in a dividend-oriented configuration, then we might say, let's use a portion of those dividends to help make up your income because you're going to be paying taxes on those anyways, if they're reinvested or not. So if you reinvest them, then you're just looking to, increase the number of shares that you have in whatever equity was producing those dividends, or you can have them go to cash. Either way, when you get your 1099 at the end of the year, those are going to be reflected as taxable items.
There are many roads to be taken to get to your objective. Some are paved a little better than others.
Sure.
Some have more risk than others. Some are better lit. Some are not better lit. I think what's important is that if you are working with a financial professional, and I'm not saying somebody who's looking in the mirror because they think they're a financial professional, but
someone that is paid for advice?
Yeah, I mean, if you're paying someone for advice, whether it's through commissions or through fees like we're paid, I think it's important to understand their philosophy.
Right.
Making sure that it fits with your philosophy and at the same time that you're following through, because every portfolio should be created with purpose.
Right. What are your goals?
Yeah. So, it's interesting because, honey, we have an email that we were sitting on this morning.
We were sitting on it, but Debbie has been sitting on hold.
Well, we're not going to make Debbie wait. Debbie, good morning. Welcome to the show.
Morning.
Thanks so much for calling.
Well, thank you for having me.
Well,
I was just calling because I got some bad news about my 401k.
Bad news?
Yes. I am a physician and I own my own business. I am an LLC.
Okay.
I am not an employee. So when my business lost money last year, I now have to take all my contributions from last year out and put them in the bank account, and any money that I earned from them, I will receive a check and I'll have to pay taxes on it.
Okay. That's not good news.
No.
No. Is that right?
Well, the answer is it is because of the plan that you have. Maybe you ought to be looking at
an alternative,
like a SEP.
Right, because 401k plans have specific rules because they're bound by ERISA, whereas there are some other options out there for sole proprietors, LLCs that have one employee that might be better suited to your needs. Right.
Well, I mean, the thing is that a SEP would end up being a better fit because then we could pick up her income flow as compared to wages, whereas most of her income is through LLC income. So I would trust your accountant and then shoot him or her.
Goodness.
And the nice part is, Debbie, is that we're at the beginning of the year.
So you can make some changes that could be significant for you.
No question about it. I mean, you could certainly have a discussion with your advisor. I would certainly recommend that, about the possibility of terminating the plan, freezing it, and putting in a new plan. You can always do that. You just can't do two plans at one time. That would require some notification to your employees. They would obviously have some rights in terms of vesting that would happen in contributions that you've made for them. They're obviously vested in theirs, but it may make sense that possibly over the long haul, what you can do is you should be able to get in, frankly, as much, if not more money, in your side, because you can actually go up to 25%, almost in many cases up to $49,000 as a contribution into a SEP, as compared to 401k, and you wouldn't be the first person to blow up their 401k and go to a simpler plan.
So definitely something to consider.
Like when people are sick, they come to you. They say they got to talk to the professionals. I would certainly have a good discussion with your professionals on that.
Yeah, I think he was as surprised as I was.
Okay, well then.
Well, that's not good.
Then I think you need. Then I guess you might be shopping around for somebody.
Right. You definitely want some forward thinking, especially in tax planning as opposed to just having to react to what's happened.
Well, you're getting 6-month reports, and whoever your
Right.
plan administrator is, I mean, I would like to think that they're a little bit so it's an oops or it's a see ya, right? You get to decide that, but we do appreciate your call. That was great.
That is a great call. I have another.
That was also a unique one.
It is a unique one because we don't hear about that often on the show, but Dad is having worked with many businesses over your
40-year
long career.
40 years, okay, honey?
That's 40 years.
Well, I would say 40, but I said it the Missouri way, so I thought people would appreciate that.
I'm sure that over your nearly half a century career, helping business owners make the right determination as to what plan they should have selected.
I love you. You're leading somewhere.
I'm leading
with this. Are we leading into an age thing here?
No. I was just saying that over the course of time, you have helped many business owners make.
What do you mean, like through the ice ages and into the whatever? Okay.
The Paleolithic period and forward, yes.
What was really fun is that you were still in college.
Was I now?
Yes, you were when I started on the air.
Yes, because you said 2006.
Uh-huh.
So that means I was in my second year of college.
That's right. And I was still supporting you then.
And
I'm very supportive of you now, even though I don't support you. I am supportive.
You are quite supportive, and look at the thanks you get.
And, there are certain ways you could support me better.
I beg to differ.
I'm sure that you do. But, most of our listeners are sitting out there, and they're laughing because they know where I'm going with this, right?
Yes, and I know where you're going with this, trying to derail it, but we're just going to end up at the grandchildren conversation again.
Well,
so here we are,
again,
all
since
roads
I have
lead.
this wealth of knowledge.
You need to pass it on to others.
The well is deep, so
the
give it to
well
me.
is deep.
Give it to me.
Let's just go to the texter.
We do love business owners, but
yeah, that was my point.
We do we do love them. I mean, I've worked with them for many years, and they're just great.
They are.
And what's cool is that most business owners don't realize that they really do have unique options and planning opportunities that the code does provide them. I mean, the Internal Revenue Code is great.
But you got to use it to your advantage.
Exactly. And we're not talking about going into gray areas. I mean, the law is very clear on how you can do things. With our physician caller just now, she had the wrong plan.
Right.
Clearly. The cool part is that it's easy to get the right plan.
Right.
And, again, talking with her professionals, hopefully they'll keep her out of trouble. But go for it.
Okay. I'm 61 years old. Plan on working as a realtor as long as I can. And I'm having fun doing it as my encore career after working 30 plus years. My goodness.
There you go.
Got to keep going. Please speak to me about how RMD calculations are figured, and secondly, any caveats I should plan for when these required minimum distributions begin occurring for me. Who is planning to live to I believe she's planning to live to age 90. I don't know why I assume this is a woman, but it just feels that way.
Okay.
But anyway.
So you preface this on an old question, like it was like about RMDs.
Well, it is.
Which I'm too young for required minimum distributions. Thank you. And they
I
just
didn't
pushed the age
preface
back.
To 72.
That's right. Which is like 100 when you're 64. Okay. So anyways.
So when you're 61, it's like 1 million.
Yeah, RMDs are easy. So what happens is that the year that you turn age 72, we look back to December 31 of the previous year to figure out what the account balance you have in your IRAs. All of them. 401ks, everything. That's
Correct.
pre-tax. There's a calculation that's done, and you can approximate it at basically 3.87% the first year. We like to say 4 because it's easy to think about. And that is a distribution that has to be made from that account prior to December 31 of that year. If you don't,
it's a big penalty because you have to
the biggest one.
Right, you pay taxes on 50% of whatever the amount was, but you still have to take the full amount out, and then you'll pay taxes on that as well.
There is one way you can reduce the impact of those and the taxation of those RMDs, right? And we're talking about that with clients every other day.
Charitable contributions.
Right. Making them directly from your IRA, not coming to you.
And then going to charity. No.
No. They have to come directly from your IRA. So what we're doing is we're telling our clients, make a list, check it twice.
Right.
Pretend that you're Santa. And who are we giving money to? They're giving us a list. We're then preparing the paperwork, and their IRAs are sending out the money. So what does this do? Use an example. Let's say that somebody has a $300,000 IRA. Their minimum distribution for the year, 4%, is $12,000. Not unusual.
Right.
They say, I'm sending X amount to the church. I'm sending this to St. Jude. I'm sending money to...
And that
Shriners,
totals
whatever
$2,000 of donations for the year.
Right. If we send them directly from their IRA, they go from $12,000 less 2 down to $10,000 of reportable income.
Right. So you've satisfied the distribution because $2,000 of that $12,000 went directly to charities or nonprofits or churches, and then you took the last $10,000 as a distribution. You paid taxes on it,
and your kids don't count. Giving your kids money is not a charitable distribution, even though you may feel
it's the right thing to do.
You know, you were holding that smile for a long... You know, I wish they could have seen this on TV.
You know, they call that a dramatic pause.
Oh, I thought that was called foreshadowing.
Like I had it loaded in the gun. I was ready to go.
Exactly, babe.
Thanks.
And, you know, I was going to say, what's interesting is that I know that we found in meeting with our clients is that many of them getting to that age, becoming adults, i.e. having to take requirement distributions, they're finding they have more assets than they really considered that they thought they would have.
Sure.
A lot of them are in a situation where they're not using that income per se to deal with expenses, deal with monthly income flows. And a lot of them are going like, what do we do with the money? Well, what we're doing is we're naturally then telling them they have to take it out. And we're, in many cases, we're creating investment accounts for them. But there isn't any reason. And we do have a long discussion about these, about, hey, you know, maybe it's time. You didn't think that you could, but you want to. Give back. Uncle Sam, you have to be, what's cool is that this is really available to folks that are getting requirement distribution. We can't, us youngsters can't do it.
No.
Think about it. It's important. I mean, you know, I make the joke, and we, you know, especially when we're visiting clients, but.
Well, if you're over 59 and a half, you can do it.
No.
You can't send
You can do 100,000. I mean, you can make a big
up
donation.
Up to 100,000, yeah.
Right. A big donation, but that's a little different than you have. I mean, that's a voluntary thing versus, hey, I'm forced out to take the money.
Oh, right. Well, that's fair, yes.
You know, I always like to talk about the fact that, you know, I'm sitting at home in the evening and I'm watching. I used to watch Fox. I don't watch it anymore. Can't watch the Whiners anymore. So what happens is that, you know, they have the Shriners Kids commercial that comes on like every 15 minutes, and I'm crying, going, you know, I'm looking at these kids. No, I am.
Want to help.
I want to help. And I keep looking at your mom, going like, have we given that money? She goes, if you ask me again, you're going to be one of those children very soon. So
gonna disown you.
Well, because we always
send you off.
No, we do that, but. You know, people, they feel like they like to do things, and they know that they're getting this money. And frankly, if they don't have the use for it, or if they're in a situation where they aren't prepared to, they don't want to.
Right.
Maybe give, you know, whatever, send money to their kids, grandkids, whatever it would be. They want to help other folks, maybe in a way that they never thought they could, but they can now. Tax code's great.
Right.
I mean, this is a real opportunity for you to do it. And truly, if you're not itemizing your deductions, which most people can't
at this point,
because they paid off their mortgages, guess what?
And also the standard deduction was doubled under the Trump administration.
Yes, and we also know that in terms of charitable donations, you can only deduct up to $300 on your return if you aren't itemizing. This way, you can give away as much as you want, or give us away truly as much as you would like to. Maybe you've dreamed about.
Sure.
I think that's great. I mean, obviously.
There is one caveat that we should mention.
Sure.
Because donor-advised funds have been growing in popularity. These are essentially vessels that allow you to make charitable contributions. However, they don't meet the requirement for a donation directly from your IRA to the donor-advised fund. That is not, because essentially what has to happen in order for you to meet the qualification is the money has to be distributed. Yes. A donor-advised fund, which many mutual fund companies are offering at this point, allows you to hold charitable contributions for as long as you'd like. They're no longer your assets, but you get to decide when they're distributed to the charities or the schools.
It's like having your own private charitable foundation.
But without all of the tax consequences or legal ramifications.
Yes, and all the filing requirements,
Right.
etc. That's kind of taking things to a next level, which I
Sure.
think we ought to talk about that a little bit in more detail. There are situations like you talk about with business owners, or even let's take our Debbie, our physician.
Okay.
That's a good
Debbie,
one.
yeah.
Debbie decides that, she's somehow been able to get the right retirement plan. She's put all this money in, and what happens is she wants to retire.
Yep.
She wants to sell her practice.
Ooh, could be a hefty tax bill.
Well, of course it is. What's one way you get around taxes? Well, one way you get around paying taxes is reducing the tax amount by making charitable contributions. She might consider, as we've had other clients do, or what they're doing is they're making a large contribution
To a donor-advised fund.
which they control, and they basically know the money's out of their hands,
Right, so you
but
get
they get to decide how.
Right. So if using the example of Debbie selling her practice, she has proceeds from the sale. She gets to take the full deduction for whatever amount she puts into the donor-advised fund.
As long as it doesn't exceed 30% of her adjusted gross income.
Right.
Which in that year could be large.
Sure. So, but once that money goes in, she gets the deduction in that year, which means she gets to reduce her tax bill
Right.
from the sale of the practice. But then the money can stay inside that donor-advised fund, and you can distribute it to your church's charities or other 501c3s as you would have already done. So, for example, if $100,000 goes into your donor-advised fund, but you're only sending $5,000 out per year, you can continue to do that. You don't have to increase your actual charitable contributions until you're ready to or want to.
And the cool thing is that you generally control the investment mix in that donor-advised fund.
So you could end up being able to donate significantly more to charity than you had actually donated to the donor-advised fund, because many of these fund companies have many investment selections available to you that you can put the money in.
Yeah, and again, we do want to thank our texter for that question.
Great
because
question.
It was a great question. It also leads us to talk about other stuff, which we think is fun as well. But
Should we continue with some of our tax deductions?
well, I think we can, but I just want to make just one other general comment.
Sure.
One of the fun things that I think that we do, and really it's our clients depend on us doing, is trying to figure out how to make lemonade out of lemons. And in fact, paying taxes is not wonderful, but it is something. But you
wouldn't qualify that
you
as
have to
wonderful?
have earned. No, you have to have earned money. I mean, you're contributing to the national good in most cases. You may
Hopefully
think,
your own too.
you may think it's too good, but it might be. But the code really is set up and gives you opportunities to defer, deflect, deduct your taxes.
Sure.
We're not talking about evasion. We're talking about avoidance.
Using the tax
Avoiding taxes is an American thing.
It's
Evading-
using the tax code to your advantage.
Yes, as much as you can. And there's nothing wrong with that.
Sure.
I mean, it's the way the game has been set up. So for those folks that are grown-ups now, they're eligible to take required minimum distributions.
Mm-hmm.
You need to think about this. You have the perfect outlet to do all the things you're currently doing and save at least 10% in taxes. I mean, literally, you're giving away $2,000, you just save $200. Not a bad deal.
Right, and also that means your charity most likely gets a little bit more, right?
Which is all good. So good. So saving taxes this year, we talked about HSAs. We talked about making retirement plan contributions. We're not going to talk about unemployment benefits only because we don't have any clients that are unemployed. Student loan interest is...
But they're retired, not unemployed.
Most student loan interest is deductible.
So if you happen to be a parent that is taken, or a grandparent that's taken on some student loans for your children or grandchildren.
Right. You can deduct up to $2,500 each year or in the amount you actually paid, whichever is
smaller.
And if you have more than $600 that you've paid, you have to form a special form called Form 1098E.
You receive that from the company that you were paying the loan, that you're repaying the loan to. So it comes to you like a 1099 would.
Exactly. And we also talked about charitable donations, which is cool. And then there's some folks that may be forced with paying for long-term care health expenses for family members, spouses, parents, etc., for those that they're financially responsible for, right?
That's right. And that also feeds into the long-term care expenses that are deductible.
Yes, it does. So there are some things that you can do before the end of the year, i.e. May 15th. Check your adjusted gross income, see where you're at. Can you make a qualified retirement plan, i.e. IRA contribution? If you can, go for it.
We have a follow-up question from our realtor, who happens to be a gentleman, so I was completely wrong.
Okay.
Willing to admit. Does the rate stay at 4% approximately per year, or how are the following years calculated? So,
No.
Unfortunately, no. It does not stay at that 4% level. I think by the time you get to 90, it's almost at 10%. Is that correct?
Yes, and 80, it's like 5%. It ratchets up every year, and again, it's based upon
The account value of the previous year.
1231 and the factor.
And your age, exactly.
And so it's called the more you make, the more you have the privilege.
It will
of
increase
contributing.
annually, but what we have found is most of our clients have retired by 72 years old, even if they have an encore career. Now, realtors and sometimes physicians or business owners are separate and apart from that. Most individuals are taking about 4% from their retirement accounts to make their lives work anyways. So they're already cash flowing about that amount. So usually in the first few years, you're not seeing a huge change in how much you need to take because you've already been taking it. Then it starts to go up, and part of what we like to do for clients is to make sure that whatever the difference between their monthly distributions are and the required minimum distribution, once it starts to exceed that we make up that difference for them.
Well, we're measuring that, and also we're talking about, are there specific goals and times?
Sure. Do you want to pay property taxes?
Right.
You want to birthday
Vacations,
celebrations?
Gifts to those wonderful children.
You know, this is a great...
If you got them.
You know, if you don't have them, that just means more for your children.
There you go.
Right.
Exactly. Touche. So, no, I mean, that was a good one.
Why, thank you. Thank you.
No, I meant that was a good question.
Oh.
From somebody else. That was good. Okay. Again, our phone lines are open. We'd love to hear from you. 931-5877, star 5877 from your cell phones, or 84126 from text line. We do have a few minutes left in our show. We certainly would love to hear from you, but we also need to take a moment and do our Smart Choices About Your Healthcare segment, sponsored by our very good friends,
Aetna and Anthem of Missouri.
Thank you so much for your sponsorship over the many years of our show.
That's right. So I received an email, and this is not an uncommon topic that I received this email on. I'm 67 years old and planning to retire July 10th. That's pretty soon. I have not signed up for Medicare, and my friends and family are telling me I will have a penalty. I even went to an educational event held by an insurance company, can't remember the name of which one, and was told something similar. What do I do?
I can answer that. Quit going to stuff.
Quit going. I know they aren't even allowed to give you a full meal, so what's the point?
It's time to visit with a professional.
Well, here's the great news. This emailer did everything correctly, which was nothing at all. If you are turning 65, you're over the age of 65, you're employed with an employer that has more than 20 employees.
Or covered by a spouse.
Or covered by a spouse who works for an employer that has more than 20 employees. You do not have to enroll in Medicare when you turn 65. And just like we talked about earlier in the show, enrolling in Medicare sometimes creates situations that lock you out of tax advantages.
Like HSAs.
Exactly. So the government is only concerned with individuals turning 65 that have individual health insurance. That means, you know, they have purchased an individual policy because they were no longer working. Or they happen to work for employers that have less than 20 employees. Or they might be an unfortunately uninsured individual. The government, Medicare, CMS, wants you to be enrolled in Medicare at that point. Those are the people that would face a penalty. Everyone that has qualified coverage, the government doesn't want to insure you. They want your employer to continue to insure you. So you won't have a penalty, and the way that we notify Medicare that you shouldn't be an individual that would incur a penalty is your process for enrollment into Medicare is a little bit different. You're going to fill out 2 pieces of paper. One is your Medicare Part B application, super simple, name, address, where you were born. And then the second is called the request for employment information. Essentially, your employer, someone in the HR department, doesn't have to be the director, just a person that can verify your coverage and potentially your spouse's coverage if they also happen to be on the plan. Will just say that, for example, this emailer was on the plan from the day they turned 65 until the last day of July when they left the employer-based plan. And that will tell Medicare to give this retiree and potentially his spouse August 1st coverage without any penalties.
And we do have a process, we as an Aaron.
That's right.
We have a process that you have engaged in for the last 8 years.
That's right.
Which has not only simplified the enrollment process for those people that have come to visit with you, but also have made sure that people don't mess up.
Well, right, because what we like to do is when you call in and request a Medicare coaching session, we're going to send a questionnaire to you that asks for your physician and your prescriptions. It's also going to ask for your date of birth and what your current coverage is. And as a first step in our process, when we sit down and chat, we're going to discuss how do you enroll in Medicare. If you're over the age of 65 and retiring and you need the special election paperwork, we're going to get you those 2 documents so you don't have to track them down yourselves. And then also, if you return them to us completed, signed by your employer, we are happy to fax them in on your behalf to your local Social Security office because, unfortunately, many of them are not open except for emergent situations to walk-ins.
Honey, I also know, and this has been in coaching session we've sat in together, that you really answer the question that people are asking. When do I have to? What are the timelines? When is it? How early should I start? How late should I enroll?
Exactly. So if we use this emailer's timeline as an example, they're retiring July 10th. That usually means that they'll have coverage through the end of the month. We'll want to verify that.
For their employer plan.
Exactly. So that means we need August 1st coverage. So we would recommend that we see this emailer relatively soon, June timeframe. So not only we can discuss what the process is for getting you enrolled, getting you that special election paperwork, you having the time to get it back to us in a timely fashion so we can get it off to Social Security and they can process it. But it also gives you the time to decide what plan is best for you to supplement your medical coverage. We're going to show you what the best options are based on that medical questionnaire that you fill out, and then you'll have some time to think about it so this doesn't become a pressure situation for you. The nice thing is Medicare is very lenient on its enrollees. So you have all the way until July 31st to submit all of this paperwork to get your August 1st effective date. Most people don't like doing that because it feels stressful not to have your cards and your ID numbers when your new coverage begins. But if you happen to be someone that wasn't necessarily planning to retire and you're under the gun, then we can absolutely help you as well. It's just we want to make sure that we're doing this in a timely manner. And as a follow-up, we have a text question. Are you referring to Medicare Part B? As I understand, Part A is automatic without a premium. Part A is not automatic unless you're already enrolled in if you were enrolled in Social Security early, say 62, they're automatically going to send you a Medicare Part A and B card. If you turn 65 and decide to enroll in Social Security only, they're going to automatically send you a Medicare Part A card. If you are like this emailer and did nothing at all when you turned 65, you don't have Medicare Part A or Part B. That's okay. If you enroll when you turn 65 into Medicare Part A because it has no premium, you are still locking yourself out of HSA contributions if you were eligible for them. So it's not Medicare Part B that has that impact. It is Medicare. It is any part of Medicare will have that impact on your ability to contribute to an HSA. But in many cases, I still don't necessarily think it makes sense to enroll in Medicare Part A when you've turned 65 if you're covered by an employer-based plan, because Medicare will be the second payer on whatever claim you have. Medicare Part A is only your facilities charge, so that means if you're admitted to the hospital. It also only has an 80% payout rate, which means you're going to be liable for the last 20%. You also have a $1,400 per occurrence deductible with Medicare Part A. So what I'm getting down to is most likely your employer-based plan will have paid at least the 80%. You generally don't have a per occurrence deductible for hospital visits with an employer-based plan, which means you're not going to get a lot of benefit out of it. And what happens if in the next year your employer decides to offer an HSA option? Well, you locked yourself out of it without even knowing, especially if you're someone that intends to maybe work several more years after. So sometimes it's better to do nothing at all.
Yeah, sometimes good things come to those that wait.
Exactly.
Especially if you're covered. So, again, what's important here is that we know that when you get to close to being Medicare eligible age, 65, you do get deluged with not only stuff in the mail, you're also getting
phone
calls, etc. Seek out the professional.
Also, it never hurts to ask, what should I be doing here? This is my situation, before you start filling out paperwork. Also, the insurance companies have become quite clever. Many of the marketing materials now appear like government documents.
Right.
The government's not sending you anything. This is completely self-elected, which is why some people unfortunately end up in a penalty situation or in a delayed enrollment situation because they didn't know what the rules were. The government doesn't seek you out. They know who you are, and they expect that you're going to request your benefits when you want them.
Well, then rule number one, give Aaron a call, 314-863-0008. 314-863-0008. If you'd like to have a Medicare coaching session, either she or one of her staff will visit with you.
That's right.
Which is cool.
It is very cool.
Staff is cool, right?
They're great.
Yes, sir. We've got about 3 minutes left in our show. If phone lines are still open, 931-5877, star 5877 from your cell phones, or 84126 from the text line, which I have my glasses on, so I can't read them too close. Honey, do we want
I've already read all of the excellent text questions so far.
Okay. So I was going to say, do we want to go to Where Does Your Money Go?
Let's do it.
Yeah. John writes me last week. He wrote me directly, so it got through the email screen or the Great Wall of China there and puts up so I can see emails. I've been a listener for many years, but you never talk about how or where you invest clients' money. Do you have a model? Can you discuss it with us? By the way, having Aaron join you on the show has made it better.
Well, thank you, John.
John wrote this. By the way, I pulled this. This was a 13-year-old email.
It's impossible.
Oh, I'm sorry. I meant a 2013 email.
A 13-year-old email.
Yeah, so it's nice.
He liked when I joined the show before it happened.
Exactly. I enjoy your banter and listening to her discussions on healthcare issues. She has a great command of a confusing era, which is true.
Why, thank you.
So, John, Aaron and I have developed 2 models for our clients. We call them Cash Flow Now and Cash Flow Later. Very simple.
And that's all dependent upon when you need cash.
Exactly. Everyone enters the Cash Flow Now model when they hit 72.
Because you got to take those required minimum distributions.
That's right. And we have found that our clients have several common objectives. First, protect the assets so they last as long as they do, so they can create an income stream. Second is to have a cash flow and liquidity available when they need it, when they want it. And then third is to grow at a rate that keeps up with their withdrawals.
And also inflation.
That's heaven, right?
Right. And that generally means that you're a moderate investor.
That's right. Those are all the characteristics of a moderate investor, which would basically be a 70% stock, 30% bond, and cash portfolio.
And unfortunately, that's really all we can reveal.
That's right.
Because we don't know you.
Not only that, but you get to find out where the goodies are if you come in for a coaching session.
That's right.
Which is easy to do. Just give us a call, 314-863-0008, 314-863-0008. Or if you like, go to our website, hit the Contact Us section,
jblfinancial.com.
We would love to see you. Thank you so much, St. Louis, for 15 years. We're getting ready for week 16 or year 16. Have a great day.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
This is Jeff Lapidus, the Retirement Coach. We'll be back next week at 10 a.m. here on the Big 550 KTRS.